But what's going on with capital goods? Is there finally a revival coming in? And if so, in what segments and pockets? Let's take it across to Avan to find out exactly that.
Well, it is not just revival, Aisha, but we're seeing an absolute complete turnaround in the overall sentiment for the business cycle for the capital goods sector. In fact, as per a Credit Suisse report, it's being described as the best shape in a long time. So let's just put all of the details into perspective. The business cycle overall really seems to be strengthening when it comes to the capital goods space. So we are seeing an incremental shift in sentiment as well. There are a lot of factors which have really contributed to this. The MHCV sales have grown. You have seen an improvement in the overall macros in terms of the IIP. The exports have shown an improvement as well. So all of this really seems to be working in favor. In fact, Credit Suisse has the index of short cycle industrial products, by which is a parameter that they use, and that has seen a double-digit growth in FY18. For Q1 of FY19 as well, that index is already up about 16%. So in all, this is boding very well for the overall capital goods sector in terms of the environment. So you have seen the inflows in terms of orders that have coming in really beefing up. For the construction sector, for example, the overall order inflow over FY13 to 15 has been an average of about 2.5 times, and now this is growing much more. When it comes to industrial companies, though, the order inflow does still continue to remain a little bit flat, but the public sector construction orders have seen a major boost, and that really is driving orders because this sector has grown manifold. There's been strong growth in the construction sector, a lot of order booking as well that we've been seeing, and that's largely been driven by public sector spending. The construction order inflows are now at 2.5 times at over 75,000 crore rupees. You've seen strong execution improvement as well when it comes to the domestic construction sector. So the aggregate orders for some of the industrial companies have remained flat, but the construction sector has seen an improvement all in all. There still seem to be some of the risks which have not dissipated completely. That's largely on account of the balance of payment deficit as well as a higher interest rate scenario, which could potentially be a dampener. But just let's put the valuation picture into perspective in terms of individual companies. It's Voltas which has the highest PE at about 34.4. They also have the highest price to book. In terms of L&Ts, it's next in line at about 22.1 PE with a 3.0 PB. You've got Dilip Bilkon as well. That's at about 18.5 times. Now, in terms of the kind of growth variables and what the overall macros are that are really aiding the sector as a whole, you have seen the power demand improve, steel consumption quite significantly. This is FY17, 18 and 19 roughly. The cement production has gone from negative to about 5.1, and even exports have significantly improved to double digits. The order inflows on average for the mid-cap companies as well, as you can see, has seen a one-way rise, and an average has grown to close to 76,900 crores from FY14 at about 33,900 crores. So definitely seeing sentiment improve.
Seeing sentiment improve, but that's not showing up in the stock price movement for a lot of these engineering companies. Thanks, Aman, for taking us through that analysis. Vinayak Chatterjee, Chairman Feedback Infra, joins in for a quick understanding on how things are shaping up for the infra cap goods space. And we also have Mr. MS Unnikrishnan, MD of Thermax, to discuss the same. Good morning to both of you. Mr. Unnikrishnan, let me start off with you. What are you seeing on the ground change to give you the sense that, you know, not just order inflow, but order announcements are also going up? There is a bigger flow of orders, so to speak, coming in from, you know, not just the private sector, public sector, it's really across the board.
I mean, for the capital goods sector, which is based on a derived demand than a primary demand, what we need to look at is existing capacities, how they are getting utilized. So you would have seen in the past 9 months consistently the capacity utilization across most of the sectors had been increasing, inching upwards from a 50% to almost touching 80% in majority of the sectors. The moment it crosses an 85%, majority of the corner rooms in the country will start getting little worried about, because unless they have the expansion programs already ongoing, in the next 2 to 3 years time, by the time they are ready with the capacity, they'll lose out in the market share. So that's where we are seeing an upsurge in ordering, both in the private sector and part of the public sector, or maybe the infrastructure oriented sectors. So it is not that something has happened overnight. We had been witnessing it for the past 9 months. For majority of the capital goods companies, we had been seeing an uptick in the order intake for the past 3 quarters. And in some sectors, it has increased by almost 40 to 45%. But on an average, taking early teen numbers, a 13 to 15% improvement in the order intake and order book is quite visible. And we are only hoping that for all the inaction that has happened in the down cycle for the past 5 years, maybe we are beginning to see green shoots of an improvement and maybe a reversal of the cycle.
Vinayak Chatterjee, morning. Reports are indicating that the business cycle is in the best shape in a very long time for the capital goods sector. What have been your own observations? Is the tide really turning? You've got a close ear to the ground. What is it that you've observed?
Well, I would first of all want to wholeheartedly agree with my good friend Mr. Unnikrishnan, whom I have just heard. And actually, it is his words which I would like to echo, which is that I don't think we should use words like dramatic turnaround and stuff like that. He has carefully chosen his words and he has said the beginnings of the green shoots of the capital ordering for the capital goods industry. So that is where we are. It is positive news, but I don't think we should over dramatize it. So Uni is right that across the board, the data is coming in that the capacity utilizations are inching closer to 80% to 85%, and that the boardrooms of companies are now looking at discussing expansion plans. Some have already taken expansion plans, and therefore the derived demand for capital goods is happening across the board. But specifically in the infrastructure sector, I think construction, industry, and everything associated with it has certainly hit boom times. There I would certainly be more dramatic for the construction sector than for the general capital goods industry. If you see the demand and production for steel, cement, construction equipment, the order books of EPC companies, all of them corroborate the fact that construction, largely driven by highways, railways, both track expansion and electrification, and metro rail, are the kind of segments that are pushing this construction boom. And there has been a pickup in retail housing, not so much the large condominiums by big builders, but apparently across the Indian countryside there has been a spate in tier 2 and tier 3 cities of people building their own houses and flats and stuff like that. So there is a pickup in retail housing, individual retail housing. So all of these things are adding up. Certainly there is a feel-good factor in there compared to what we have seen in previous years, and I think we all look forward to that.
Mr. Unnikrishnan, my only follow-up then is, if things are looking up in terms of the order book position picking up, is that also translating into higher profitability, or given the competitive scenario, the value of the orders are getting a little diminished?
Well, Tanvi, there is one lag factor. Normally, when the ordering improves in the market, you will have the commodity prices following up the lead factor of the order intake. However, this time, purely owing to the support given by the government of India in minimum import price for steel, we've seen the price of commodities going up by almost 40+% in the last 18-month period of time. So most of us had to be factoring in the revised input costs across the board, even with petroleum prices really going up through the roof in the last 1 year, where you would have a ramification of that manifesting into various other input costs for the industry. Margins are generally under pressure. However, the recent devaluation of Indian currency, though as an Indian I may not like it, but as an exporter I love it that way. So maybe a part of that will get compensated for the international orders. So the margins, I will not want to say we have come to a level of a seller's market where we can demand a margin. The competitive pressures of various natures are playing on the balance sheets of companies. But I think we will see an improvement in this, because I don't think the global commodity price is going to going up any further, at least in the foreseeable future. There is a stability being visible. Indian currency, as I mentioned about having loosened a little bit, will improve our competitive edge. And that should give us a room for improving the margins, not in the next few quarters. I would say next few years you should see, if the trend were to continue, all the Indian companies in the capital goods sector will come back to a profitability that we were used to in the last positive cycle.
Mr. Chatterjee, would you tend to agree with Mr. Unnikrishnan here as well in terms of margins and profitability that some of these companies can see? That's going to take some time to come?
Well, that's very clear. I mean, margins have obviously got eroded in the down cycle. So as we are looking at the up cycle, the market will readjust and capital goods will see their margins moving up compared to the down cycle. So that is self-evident.
Right. Okay. My only follow-up then is, Vinayak, on the competitive scenario for these order wins. Is there enough scope and scale for all of the players to kind of garner more of the order flow that's coming through, or it's going to be very competitive?
Well, it's a very generic question that you're asking me to answer, but let me therefore craft my reply with specific reference to project exports, because Uni's also touched upon the increasing attractiveness of export markets based on a weakening rupee. Now, what is happening is that there is certainly a burgeoning order book from the African continent for Indian project exports and related, capex with it, from the African continent, largely sub-Saharan Africa, and from the Gulf area, and from South and Southeast Asia, including Indonesia. Now, we are finding that in many of the countries, the export-import banks or the development organizations of countries like China, Japan, Korea are providing huge degree of bundling of cheap state finances through their Exim banks or organizations like JICA, etc. That is putting Indian project exposures at a disadvantage. So the capital base of India's Exim Bank is pretty low compared to the size of the Exim financing outputs of outfits of these countries. So I think India should, like we capitalized on the IT boom in the 90s, India should work out a strategy for actually being far more aggressively supporting and pushing with state support, with bundling cheap finance, long-term cheap finance through our Exim Bank in a far larger manner that we've been doing in the past. And I think if that is done, the project exports market could be the next big thing that would happen to India after IT exports.
Right. And Mr. Unnikrishnan, do you agree with Vinayak, in terms of the scope and scale there is for growth in businesses like yours, that, one can bid profitably as well as, have a level playing field when it comes to competing with other players?
Why not? In fact, Vinayak and I work together, and we continue to be working together in the infra space with the government of India to make the people understand acquiring orders in capital goods and project side is not a one-time affair. If you capture an order, the life cycle of operation maintenance and the spare parts and upgrades that the country will gain in foreign currency will last for 20 years. So it's a necessity for India to learn from the other countries like North America, European banking system, Chinese banking system, Japanese banking system, as you mentioned about. See, the main issue that we need to resolve over there, as we understand, both of us do understand very well, is that the tenure of loan from India from Exim Bank is 7 years and 10 years, whereas a Japanese bank will give a 40-year tenure loan, and the interest rates applicable are maybe marginal, 1% to 2%, and most so this is supported by the sovereign funding which is indirectly coming to them. We have not reached that level. I don't think the powers that be in this country has recognized the potential of the project export capabilities of the country. Remember, 2/3 of the world is yet to be developed and infrastructure is going to be building. And to partake in such kind of larger projects, you're going to have a funding provision made available. And unless we do that, I don't think we can, increase our projects in a magnitude that is done by Chinese. All of us are individually and as companies working. For example, as you mentioned about, we ourselves have taken a 200 million size of an order from Southern Africa without any funding support. But if funding support were to be made available from the country, maybe that 200 can become a $2 billion for one company. So the potential for all of us to do is, we're talking about is $20 to $30 billion additionally than what we do currently, which is around 8 to 10% of India's total exports. So there is a huge potential available over there. And it is not only companies, the government has got to ensure that they stand by us. We have the capability to do that. we may not have the muscle power to support this kind of exports.
Okay, Vinayak, as well as Mr. Unnikrishnan, thanks very much for joining us with your perspective on where the cap goods story is moving from a business cycle perspective and how things are only likely to look up from here.